The opinions and recommendations expressed by Dan are his own and do not necessarily represent the opinions of this station or any of the show's sponsors.
Welcome back, Financial Issues. I'm Dan Celia, 866-300-9298, 866-300-9298. The Dow is up 21. S&P is up 4. So that's where we are right now. Oil, by the way, over $100 a barrel. I think I mentioned that at the top of the hour, but oil retakes $100. Looks like it's going to hang there for a little bit. It's been hanging around that 99 range for the last week and a half or so. Gasoline up, and it looks like we can expect higher gas prices just about at the time I get totally dug out and the snow starts to melt, and everybody else and starts driving a little bit. Gasoline prices will be going up, according to AAA and some others. Let me go back to Chris from Connecticut. Chris had a question, a follow-up question. Go ahead, Chris.
Thank you, Dan. I was wondering, at what age should someone start thinking about a charitable gift annuity?
Yeah, that's a good question, Chris. I would say, realistically, probably 45 to 50 at the earliest. I mean, I know young people that have done, and I'm throwing you in that category, young people who have, on a regular basis, like every year, in lieu of their IRA savings, has done a charitable gift annuity and, deferred the income, to 65 or whatever it is, and that have done that for years. It's getting a little bit more difficult to do that. And what I mean by that is, so the IRS, when you do a charitable gift annuity, the IRS, when you're getting a rate. Okay, so the charitable gift annuity says we're going to pay you, it's like a CD rate. We're going to pay you when you retire, you're 40 years old, you're going to retire, we're going to start paying you at 65. So, you're going to get 9.5%, 10%, whatever it might be. And you're going to get that for the rest of your life. So the IRS dictates that. It's got nothing to do with the ministry. It's the IRS. The IRS publishes and puts out a discount rate that the Gift Annuity Association puts together. Everybody uses the same rates, their IRS rates, which determine what your charitable deduction is going to be, how much of that income is going to be tax-free, usually about half to 60% of it is tax-free, and the rate of, what the return is going to be for that gift. So it goes through all those things. There's a couple other things that it factors in there as well, and it's based on age and some other things. But there's a law, and I'm trying not to get deep into the weeds here, and I don't know, I'm trying to figure out how I can explain it, but there's a thing called a 10% rule by the IRS. Basically what it says is that there can't be a risk of the person outliving plus 10% outliving the value of all the money that they've put in there. Now, it doesn't matter if that were to happen. The ministry still will pay the income, but the IRS does not want to see this 10% rule being violated. Unfortunately, that 10% rule is based on an average return within certain indexes of the markets, which are a lot of bonds and a lot of conservative kind of markets. So it's been harder to make, it factors in some other things, it's been harder to make the 10% rule. So somebody 40 years old might not pass the 10% rule. Now that's changing because we've had 2 very good years in the market. So it's actually getting better. It was getting bad for 10 years prior to that, but it's starting to get a little bit better. So, I would always say at any age, you can certainly check out to see if it makes sense, but probably the best time would be, at the earliest, would be somewhere between 45 and 50. And that could change dramatically as you see interest rates come up on CD rates. You know that it's even getting better. The charitable gift annuities will always be quite a big difference between CDs and charitable gift annuities. And as interest rates go up, that kind of factors into that 10% rule, and it gets even better. So anyway, I know that's complicated, but I wouldn't think about it. I know, like I said, I know a number of people, I said this yesterday, that have done this for years and might have 10, 15 different annuities so far. I don't know, but have done it for years. So, but it's really difficult at a very young age.
Okay, well, wonderful. That answers my question. Thanks again, Dan. Have a good one.
Chris, thank you for listening. I sure appreciate it. Let me go to Jimmy. Jimmy calling us from Oklahoma. Hey, Jimmy. Jimmy, how are you?
Hey, good morning, Dan. You doing
good morning.
All right?
Good.
Thank you for taking my call.
Sure thing.
Yeah, I was wondering about that $26 trillion that George Bush borrowed from the federal government. We could never make up for that, and all them billions of dollars he spent in Iraq, and then he bought an airstrip in Turkey for $26 million that wasn't nobody using. I mean, how can you make up for a deficit like that?
Well, that's a good question, Jimmy. I guess the bigger question is, how do you make up for more than doubling that? That's the bigger question. So you've got George Bush, who left us with not quite $9 trillion of deficit. And then we've got another president that comes in. George Bush did that in 8 years. And then we've got another president that comes in and in 5 years doubles that. How do you make up for that? So you make a good point if you think that it was bad then, and how do you make up for it? Can you imagine where we are today and how we could ever begin to make up for it today? Very, very difficult. There's only one way you make up for doubling the deficit in 5 years. There's only one way that you can possibly make up for a $19 trillion now in deficit. The only way you can do that, or headed towards $19 trillion here by the end of this year, probably. The only way you can do that is with exceptional growth in the economy. The only way you can do it is with a lot of people employed, a lot of people getting raises, growth in the economy in that companies are producing more goods and services than at any other time, by consumers spending more money than at any other time. So when that happens and the revenues in dramatic fashion begin to flow into the government, that will allow the government to continue its spending spree. At least they'll have a little bit more money to spend, and that will somehow control the deficit. The other way that you take care of it is, of course, that you've got to cut some of the incredible spending that has been going on. And I don't know how you do that when, by all accounts, one account in particular, because of the paperwork that Obamacare alone has created, because of that paperwork alone, it's going to take 33 years to try to pay for the cost that is involved in administering that paperwork. So I don't know how you ever get it under control. Frankly, that is my concern with our economy. I don't know how you get it under control when you're doing nothing to slow down that freight train that's headed for the cliff. So, good question. Thank you, Jimmy. 866-300-9298. Let me go to James in Ohio. Hey, James. James, you with us? All right, we don't have James. Let me go. We'll put James on hold. I don't know. Maybe, I don't know. Let me go to Barbara in Louisiana. Hey, Barbara.
Hey, good morning, Dan.
Good morning.
Listen, thank you for taking my call.
Sure.
I was listening to your station yesterday, and you had your guest, Twyla Grace, on.
Yes.
And I'm not sure I understood correctly. You was talking about changing file exemptions to $9.99. Is that because you said something about IRS is not sending refunds because of Obamacare, or did I misunderstand that? I'll take your answer off the phone. I'll hang up.
All right. Thank you, Barbara.
Thank you. Bye-bye.
Thank you. Thank you. No, you misunderstood that. what she said, Barbara, and what we were talking about is that the only mechanism that the IRS has right now of collecting any fines because you're uninsured is to take it from your refund. So what she was saying is, if you don't have a refund coming to you, then they don't really have any way of collecting it. So what you want to do is avoid, and once they collect it, even if they're wrong and they're plagued, the IRS is plagued with all kinds of faulty defaults in their system, that they could arbitrarily collect it from someone that's got a refund, and it could take years for you to get it back. So what Twyla was saying is you may want to consider being careful about not getting a refund. And what I said after that was how you do that is that you declare. So you know that W-9 form that you fill out with, where it asks you when you have a job or you get a job, how many dependents you want to declare? Because how many dependents you want to declare determines how much your taxes your employer is taking out of your pay. So if you declare 0, they're going to take the maximum amount of taxes out of your pay, which generally means you've got a better chance of getting a refund. But if you declare 6 dependents, then they're going to take out a lot less, and you may have to pay a little bit of taxes when you do your filings. Now, here's the thing to understand, because it's a little confusing. Well, how do I declare 6 dependents when it's just my husband and I? I mean, it's just the two of us. I can't declare 6 dependents. I don't have 6 dependents. No, you can declare 6 dependents when it comes to withholding taxes. But when you file your tax return at the end of the year, you can't declare 6 dependents. You can only declare 2. You can't. You can't make up dependents. You're not allowed to do that. You are allowed to do it from a withholding standpoint, but when you file, you have to file the actual amount of dependents that you have. But that will reduce it. And maybe last year you got a $2,000 return on your taxes. That could create a situation where you only have to pay $50, or you only get $50 back. So it takes a little while to kind of figure it out as to, where that kind of break-even point is. But something to consider if you're going to not get health care through the exchange. So hopefully that answers the question. We were talking about so many different things yesterday. That's why I need to get her back. Let me go to Brenda in Kansas. Hey, Brenda.
Hi, Dan. Thank you so much for taking my call.
Sure.
I have an IRA, and I'm feeling like I made a big mistake. I put it all in precious metals.
Mm-hmm.
And I would like your advice to maybe, should I go ahead and sell it? And if I should, they're telling me I have to pick a dealer to sell it. And then once the money's back in the account, then I can move it where I want. And then if that's what you're recommending, where should I put the money then? I'm single. This is the only retirement that I'll have so far.
When did you do it, Brenda? When did you?
It was a few years ago. I'd worked for a company for 15 years, and they got bought out.
Mm-hmm.
So it's probably been about 10 years ago.
And are you up? Do you have more money in there value-wise than you did when you put it in?
I don't know. I'm not very good at keeping up with that stuff.
That's fine. So here's the thing. Unfortunately, you're going to have to pay exorbitant fees. Did they tell you that when you find that deal?
No, they didn't.
Okay. So you're going to have to pay a great deal of commission when you do that. That's why I asked you if you were up in the account. And it's a very difficult thing to get out of because of that. So you might have to pay I was talking to someone last week that had to pay a 40% commission to sell and get out. So you've got to look at that, because it's awfully hard to take a 40% hit on your account. Now, if you're up 50% or even 40%, at least you break even. So I would tell you to investigate that a little bit. You know, I'm going to put you on hold, Brenda. I'm going to continue to talk about this after the break. If you have a follow-up question you want to answer, stay on the line. But I'll talk about it anyway when we get back. 866-300-9298. We'll be right back.